How are you doing? This is David W. Williams, and what we're going to talk about is why Jerome Powell needs you to be unemployed to lower inflation. And what we're going to kind of really break down is the FOMC meeting that happened, I want to say maybe a week and a half ago. And there was a lot of really interesting things that were about in that meeting. And what we're going to do is we're going to cover some of those things. And as we get towards the end of this particular broadcast, I think there's a lot of really essential information that you would probably want to hear if you want to start forecasting what we think the next year, maybe 2 years is going to look like. Also, for the people that actually trade the market, to me, there's some really good information to try to get you to understand how the overall market can be impacted by federal monetary policy. And that's probably why you want to stay tapped into the end of this particular video. We're going to try to make this as short as possible because I understand everybody wants to get back to the holidays. People starting to drink their eggnog, they're starting to kick back and relax. And we want to try to help you get back into it. But what I want you to understand is this: the market's going to be closed on Monday. Once we get back to it on Tuesday, everybody's going to hit the ground running. Most people are going to come back into the market, let's say early January, they're going to hit the ground running. The average person is still going to be trying to figure out what they're going to be doing with the rest of the year. Understanding these type of things is how you prepare yourself for the future, because the business owners, we did a CarMax earnings call earlier this morning. They're already forecasting out for the next 12 months. And this is how you put yourself in a position to win. You don't wait till everybody else moves. You already know what moves you're going to make based on your own analysis and your own forecasting. You're not waiting for a quote unquote expert to tell you what the rest of the year is going to look like. You've already figured that out on your own. And that's what we're going to kind of talk about. Really quickly, for the people that don't know, we're still having our December sale on the core options course. Going to give you 15% off. Use the code December 15th, and that's going to be the lowest price of the year. Also going to be the lowest price of 2023, because we're going to keep raising that price as time goes on. So I want to really encourage you to tap into that, and we're going to go ahead and get right to it. So let me go ahead and set up this video, and we're going to jump right into it.
Good afternoon. Before I go into the details of today's meeting, I'd like to underscore for the American people that we understand the hardship that high inflation is causing, and that we are strongly committed to bringing inflation back down to our 2% goal. Over the course of the year, we've taken forceful actions to tighten the stance of monetary policy. We've covered a lot of ground, and the full effects of our rapid tightening so far are yet to be felt. Even so, we have more work to do. Price stability is the responsibility of the Federal Reserve and serves as the bedrock of our economy. Without price stability, the economy doesn't work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Today, the FOMC raised our policy interest rate by a 0.5 percentage point. We continue to anticipate that ongoing increases will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. In addition, we're continuing the process of significantly reducing the size of our balance sheet. Restoring price stability will likely require maintaining a restrictive policy stance for some time. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. The U.S. economy has slowed significantly from last year's rapid pace. Although real GDP rose at a pace of 2.9% last quarter, it is roughly unchanged through the first 3 quarters year. Recent indicators point to modest growth of spending and production this quarter. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Activity in the housing sector has weakened significantly, largely reflecting higher mortgage rates. Higher interest rates and slower output growth also appear to be weighing on business fixed investment. As shown in our summary of economic projections, the median projection for real GDP growth stands at just 0.5% this year and next, well below the median estimate of the longer run normal growth rate. Despite the slowdown in growth, the labor market remains extremely tight, with the unemployment rate near a 50-year low, job vacancies still very high, and wage growth elevated. Job gains have been robust, with employment rising by an average of 272,000 jobs per month over the last 3 months. Although job vacancies have moved below their highs and the pace of job gains has slowed from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. The labor force participation rate is little changed since the beginning of the year. FOMC participants expect supply and demand conditions in the labor market to come into better balance over time, easing upward pressures on wages and prices. The median projection in the SEP for the unemployment rate rises to 4.6% at the end of next year. Inflation remains.
Okay, so let's stop right there because we kind of flew by some stuff. We want to make sure that we cover this, right? So the first thing that we want to talk about at 651, he said that a 0.5 rate, more raises are going to be appropriate. So he already projected that as we go into the rest of the year, that they believe that more rate raises are going to be appropriate. So what it means is that they're going to continue to contract the economy, right? Then at 710, he says that they're going to have to maintain that restrictive policy. So what a lot of people were projecting is that the Fed is getting ready to pivot. They're going to stop the rate raises and they're going to start lowering the rate raises as we get ready to go to 2023. He's confirming that they're going to continue to raise the rates and then to hold that particular restrictive policy, right? Then at 816, he says the labor market is tight and there's a 50-year low in unemployment. And I think a lot of people really need to understand that. The labor market is very, very tight and we're at a 50-year low in unemployment. And one of the reasons why they believe they have to continue to increase in unemployment, and we're going to kind of talk about it as we get later into the video, is because the middle part of the employment market, right? So we're getting a lot of information around big tech, a lot of tech firings, but that's not who employs the majority of people inside the United States. It's really small businesses. They're very stressed to find workers. And the Fed does a lot of surveys. They do a lot of outreach to everybody across the board. They just don't talk to the big businesses. And they understand that, especially in the service sector, a lot of people cannot find employees, and then they're worried about losing the current employees that they have. And we're going to go into some of the implications behind that particular issue. 844, it talks about demand exceeding supply of workers, right? So what we understand is that there's a certain demand for workers, right? And we have exceeded that supply, right? So what it means is that there's more demand than actually workers that exist. And there's a reason for that. And we're going to also go into that later on in this particular video that I think a lot of people may not be aware of. Then at 908, he talks about it and they show the graph, right? So you can go back over it. They want a 4.6 unemployment rate at the end of next year, right? They want the unemployment rate at the end of next year to be around 4.6%. The question you want to ask yourself is, where's the unemployment rate at right now? If they wanted to be 4.6%, where is it currently at now? And then you understand where we have to go from where we're currently at now to where they need to go. So then that means that more people are going to be unemployed. The question you want to ask is that, is one of those people going to be you? However, they're sitting in this room and they're already projecting an increase in unemployment. And this is what a lot of people miss. So this is a public meeting. I don't have secret access to a website or a server where I get access to this information. This is not a mass conspiracy. This is a public meeting done in the middle of the day in which you now, because of the access to the internet, can actually watch it live and you can see what the central bank's projections for unemployment are going to be based on their monetary policy. And this is why I think that this type of information can be important to just a regular 9-to-5 worker, because they understand how the central bank is forecasting the employment situation for the United States pretty much over the next 4 years. Okay. Let me make sure we covered all the points. Okay, let's keep going. So we go ahead and keep getting right into it.
Means well above our longer run goal of 2%. Over the 12 months ending in October, total PCE prices rose 6%, excluding the volatile food and energy categories. Core PCE prices rose 5%. In November, the 12-month change in the CPI was 7.1%, and the change in the core CPI was 6%. The inflation data received so far for October and November show a welcome reduction in the monthly pace of price increases. But it will take substantially more evidence to give confidence that inflation is on a sustained downward path. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has contributed to upward pressure on inflation. The median projection in the SEP for total PCE inflation is 5.6% this year and falls to 3.1% next year.
Okay, so we're seeing that they're already projecting where the median PCE inflation is going to be. So they have it ended at a little around 5, a little over 5, almost 6 the end of this year, and starting to go down subsequently. So those are their projections. Now, this is what you want to understand. If we start getting PCE reports that are higher than their projections, they're going to have to readjust their policy. Same thing if they're lower. But people want them to be lower. What happens to the market and what happens to the analysis if they start coming in higher? And we're going to kind of talk about some of the things that can make these PCEs come in higher. However, based on their projections, right, they see the PCE inflation starting to go down, especially as we get ready to go out into 2025, as far as median PCE projections. And this information is publicly available. You can go to the Federal Reserve Bank and look right at it. And these are their projections coming from the central bank. Okay, let's get right back to it.
2.5% in 2024 and 2.1% in 2025. Participants continue to see risks to inflation as weighted to the upside. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The longer the current bout of high inflation continues, the greater the chance that expectations of higher inflation will become entrenched. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. At today's meeting, the committee raised the target range for the federal funds rate by 0.5 percentage point, bringing the target range to 4.25% to 4.5%. And we are continuing the process of significantly reducing the size of our balance sheet. With today's action, we have raised interest rates by 4.25 percentage points this year. We continue to anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation to 2% over time. Over the course of the year, financial conditions have tightened significantly in response to our policy actions. Financial conditions fluctuate in the short term in response to many factors, but it is important that over time they reflect the policy restraint that we're putting in place to return inflation to 2%. We are seeing the effects on demand in the most interest-sensitive sectors of the economy, such as housing. It will take time, however, for the full effects of monetary restraint to be realized.
Okay, and I want to stop this here. So when they raise the rates, and let's say that the housing rate goes up, it costs more to get a car because of the credit markets. It costs more to get any kind of unsecured loan because of the credit markets. It may cost more to get business credit because of the credit markets. The whole economy has to adjust to that. And what the market often does is it says, okay, the rate raise is going to be X amount. Then they forecast how they think the overall market is going to respond to that. The bond market does it, and also the equities market does it. However, the Fed's job is to see, after we raise the rates and these raises go throughout our economy, how does the economy respond to the rate raises? And then based on that new data, then we know what our next step is. What the Fed can't do is say, well, we're going to forecast we're going to raise the rate, and then this is going to happen. And so then based on that, that's going to be what the next rate raise is going to be. But that's what the market does. And that's why it can benefit you to understand the difference between the two, right? What a lot of the financial media does is that they try to project their own idea on what's going on in the market. And the Fed's job is to say, okay, well, we've made this change. Let's look at how the market is responding to it. And then based on that, we make our next change. And so he's explaining, the housing market has changed, but people saying, well, the housing market is going to crash because of the federal funds rate going up. But the challenge is that it's easy to say that on the internet, but it's not really based on any data, right? And so you kind of want to separate between people just making inflammatory comments because that's how they get attention to their media platform, and what the data is actually telling you based on, okay, this is what we're seeing. There's nothing wrong with forecasting, but a lot of people are trying to forecast 2 years out ahead of a policy change. And they've never been successful at doing that at any point in their life. But now this is like the thing to do. Let's get back to it.
Especially on inflation. In light of the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation, the committee decided to raise interest rates by 50 basis points today, a step down from the 75 basis point pace seen over the previous 4 meetings. Of course, 50 basis points is still a historically large increase, and we still have some ways to go. As shown in the SEP, the median projection for the appropriate level of the federal funds rate is 5.1% at the end of next year.
Okay, so we're seeing this graph. So we have a 5.1% raise. So we believe currently at this time that based on all the information that we currently have, that the federal funds rate in 2023 will end up at around 5.1%, right? And then once they get it there, how does the market respond to that federal funds rate being the house? So that's going to make all financing more expensive across the board. The only way we don't get to the 5.1% is if between now and that 5.1% raise, they start getting data back that shows that not only is inflation going down, but in my opinion, that the labor market is starting to soften. And I really think what they're looking for is a labor market starting to soften. I think that they believe they have to raise the rate to around 5.1%. And it may even have to go higher to soften this labor market, because that's the only tool they have available. And we're going to kind of go into that, right? We're going to speed this up once we get out of this segment, because I want to get to that part. Don't want to be holding people tonight. I know we're getting ready to go into the holiday, but I want people to really understand these are the real conversations that are going on around about this economy, where it don't have anything to do with Deion Sanders. It don't have anything to do with Megan Thee Stallion. It don't have anything to do with what's wrong with black men and black women. It has to do with the people that are actually in position, that actually can make things happen based on what comes out of their mouth and what decision they make. And then how everybody else in the economy, but also in the world, is going to have to respond to that. So the question I want to ask you is that what conversation do you think is more valuable for you to be tapped into? Let's get back to it.
A 0.5 percentage point higher than projected in September. The median projection is 4.1% at the end of 2024 and 3.1% at the end of 2025, still above the median estimate of its longer run value. Of course, these projections do not represent a committee decision or plan, and no one knows with any certainty where the economy will be a year or more from now. Our decisions will depend on the totality of incoming data and their implications for the outlook for economic activity and inflation. And we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the long run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Steve Leisman, CNBC. Thanks for taking my question, Mr. Chairman. You just talked about the importance of market conditions reflecting the policy restraint you put in place. Since the November meeting, the 10-year has declined by 60 basis points. Mortgage rates have come down. High yield credit spreads have come in. The economy's accelerated, and the stock market's up 6%. Is this loosening of financial conditions a problem for the Fed in its effort and its fight against inflation? And if so, do you need to do something about that? And how would you do something about that? Thank you.
So as I mentioned, it is important that overall financial conditions continue to reflect the policy restraint that we're putting in place to bring inflation down to 2%. We think that financial conditions have tightened significantly in the past year, but our policy actions work through financial conditions, and those in turn affect economic activity, the labor market, and inflation. So what we control is our policy moves and the communications that we make. Financial conditions both anticipate and react to our actions. I would add that our focus is not on short-term moves, but on persistent moves, and many of course, move financial conditions over time. I would say it's our judgment today that we're not at a sufficiently restrictive policy stance yet, which is why we say that we would expect that ongoing hikes would be appropriate. And I would put you to the SEP again for our current assessment of what that peak level will be. As you will have seen, 19 people filled out the SEP this time, and 17 of those 19 wrote down a peak rate of 5% or more, in the fives. So that's our best assessment today for what we think the peak rate will be. You will also know that at each subsequent SEP during the course of this year, we've actually increased our estimate of what that peak rate will be. And today, the SEP that we're published shows, again, that overwhelmingly FOMC participants believe that inflation risks are to the upside. So I can't tell you confidently that we won't move up our estimate of the peak rate again at the next SEP. I don't know what we'll do. It will depend on future data. What we're writing down today is our best estimate of what we think that peak rate will be based on what we know. Obviously, if the inflation data come in worse, that could move up, and it could move down if inflation data are softer.
Okay, so what he really said is that we're not at a policy rate that is restrictive enough. And I think that's what a lot of people are looking for him to say, because like I said before, is that the equities market, the bond market, the financial media, what they try to do is take the information that's currently going on right now, and they try to project out 6 months to a year, 24 months past that, determine where we believe that the inflation rate is going to go down at a faster rate than maybe the Fed is expecting. So therefore, we're going to adjust our analysis. The Fed has been saying from a consistent basis, until we see some continuity in data that the inflation rate is going down, what we're going to do is we're going to continue to stay on track, right? And so that's what I want kind of people to really understand, is that a lot of people will give you a projection, one that they're not positioned in financially, because that's how they get attention to their situation. But it often has nothing to do with what's actually going on, because they don't necessarily really have the data. But there's a lot of reasons why the financial media has to do that. One of the biggest things is they need to keep people engaged on a day-to-day basis. Let's get right back to it.
Gina.
Gina Smilek, New York Times. Thanks for taking our questions. The SEP, like you mentioned, suggests that the Fed will be making another 3/4 percentage points worth of rate increases in 2023. I wonder if you would foresee that being in 25 basis point increments, 50 basis point increments, sort of how you see the speed playing out going forward. And then I wonder what you're looking at as you determine when to stop.
Yeah. As I've been saying, as we've gone through the course of this year, as we lifted off and got into the course of the year, and we saw how strong inflation was and how persistent, it was very important to move quickly. In fact, the pace with which we're moving was the most important thing. I think now that we're coming to the end of this year, we've raised 425 basis points this year, and we're into restrictive territory. It's now not so important how fast we go. It's far more important to think, what is the ultimate level? And then at a certain point, the question will become, how long do we remain restrictive? That will become the most important question. But I would say the most important question now is no longer. So, and that applies to February as well. So I think we'll make the February decision based on the incoming data and where we see financial conditions, where we see the economy. And that'll be the key thing. But I mean, for that decision. But ultimately, that question about how high to raise rates is going to be one that we make looking at our progress on inflation, looking at where financial conditions are, and making an assessment of whether policy is restrictive enough. I've told you today we have an assessment that we're not at a restrictive enough stance, even with today's move.
Okay, so he continues to reiterate that the current policy, right, I think it's 4 3/4%, where we're currently at now, is not restrictive enough. So he's continuing to communicate to the market that based on all the data that we have and based on where we think we need to go, the current policy is not restrictive enough. And I think if you're just looking at PCE data comes out tomorrow, there's components to what they're looking at. It is not just CPI or PCE data. That's part of it, but they have a comprehensive understanding of data. What the market is doing is just looking at this one data point. And this is what people do on the internet. They're very binary in their analysis. And they're looking at the one data point and they're saying, well, the one data point is at or under expectations. That means that policy is going to reverse. And what he's constantly been trying to reiterate is that there's a comprehensive set of data that we're looking at. And even if this part of the data looks good, if the other two pieces don't look good, it means that we're not necessarily where we want to be. And then we have to utilize our tools to try to get that particular type of reaction out of the financial markets. Let's get back to it.
And we've laid out our individual assessments of what we would need to do to get there. At a certain point, though, that we'll get to that point, and then the question will be how long do we stay there? And there the strong view on the committee is that we'll need to stay there. It's really that inflation's coming down in a sustained way, and we think that will be some time. Now, why do I say that? If you look at you can break the inflation down into 3 sort of buckets. The first is goods inflation, and we see now, as we've been real for a year and a half, that supply conditions would get better, and ultimately supply chains get fixed, and demand slows down a little bit, and maybe goes back to services a little bit, and we start to see goods inflation coming down. We're now starting to see that in this report and the last one. Then you go to housing services. We know the story there is that housing services inflation has been very, very high and will continue to go up actually as rents expire and have to be renewed. They're going to be renewed into a market where rates are higher than they were when the original leases were signed. But we see that the new leases that the rate for new leases is coming down. So once we work our way through that backlog, that inflation will come down sometime next year. The third piece, which is something like 55% of the index, PCE core inflation index, is non-housing related core services. And that's really a function of the labor market largely. The biggest cost by far in that sector is labor. And we do see a very, very strong labor market, one where we haven't seen much softening, where job growth is very high, where wages are very high, vacancies are quite elevated, and really there's an imbalance in the labor market between supply and demand. So that part of it, which is the biggest part, is likely to take a substantial period to get down. The other,
Okay, so he just repeated it. So they're very looking at the labor market. He's talked about multiple times that the demand for labor is well greater than the supply, or the supply is well less than demand. He's talked a bit about this at multiple FOMC meetings. And like I said before, I think that's really what they're worried about, right? I think they believe, based on current market conditions, that really the supply chain inflation will probably take care of itself, right? But I think they're really worried about the fact that there's a lot of employers looking for work. They're looking for employees, and they can't find them at the price that they want to pay for them. And that can cause an issue in the economy. And a lot of people should ask themselves, if they're an employer and they needed to hire X amount of people at X amount of dollars, and they couldn't find those people to hire at X amount of dollars, what would they do? Because the average American never has to ask himself that question, because they never have to hire anybody. But an economy doesn't work if the employers in the economy need to hire X amount of people, right, at X dollars, and they can't find them unless we do what? We got to bring in a whole pool of people that are willing to do that work at that particular dollar amount. And then we're going to kind of get a better understanding of what's actually going on in the economy. Let's get back to it.
The goods inflation has turned pretty quickly now, after not turning at all for a year and a half. Now it seems to be turning. But there's an expectation really that the services inflation will not move down so quickly, so that we'll have to raise it higher to get to where we want to go. And that's really why we are writing down those high rates, and why we're expecting that they'll have to remain high for a time.
Howard Schneider with Reuters. Thanks for taking the question. You described GDP growth in the SEPs as moderate or modest, I believe, yet it's really approaching stall speed. Half a percentage point is not much. You described labor market unemployment rate as representing some softening, but it's nearly a full percentage point rise, and that's well in excess of what has historically been associated with recession. Why wouldn't this be considered a recessionary projection by the Fed?
Well, I'll tell you what the projection is. I don't think it would qualify as a recession, though, because you've got positive growth. The expectations in the SEP are basically, as you said, which is we've got growth at a modest level, which is to say about a half a percentage point. That's positive growth. It's slow growth. It's well below trend. It's going to feel like a boom. It's going to feel like very slow growth, right? In that condition, labor market conditions are softening a bit. Unemployment does go up a bit. I would say that many analysts believe that the natural rate of unemployment is actually elevated at this moment. So it's not clear that the forecasts or inflation are above of unemployment. We can never identify its location with great precision. But that 4.7% is still a strong labor market. If you look, you've got the reports we get from the field are that companies are very reluctant to lay people off, other than the tech companies, which is a story unto itself. Generally, companies want to hold on to the workers they have because it's been very, very hard to hire. So, and you've got all these vacancies out there far in excess of the number of employed people. That doesn't sound like a labor market where a lot of people will need to be put out of work. So that there are channels through which the labor market can come back into balance with relatively modest increases in unemployment, we believe. None of that is guaranteed, but that is what their forecast reflects.
Okay, so we wanted to stop there because what's unusual is that a guy from Reuters who looks to be a veteran reporter, and he could just be his first time on this assignment, he asked the Fed about recessions. It's not the job of the Federal Reserve to announce a recession. Neither is it the job of the president. And so this is where we get a lot of people that don't kind of understand. I don't know how to say this properly. Like in the military, everybody got a role when you just worry about your job. This is kind of how organizations really work in the real world. Now, on the lower level of the organization, people don't really understand that concept. And they don't really kind of understand separation of duties. It's not the job of the central bank to announce a recession. There's another office that actually announces the fact that the United States is actually in a recession. It's not even the job of the president of the United States, right? Therefore, to ask the president, well, isn't this data pointing to the fact that we're in a recession? To ask the chairman of the central bank, doesn't this data point to a recession? It's not his job to announce that, right? So that's not his assignment in this organization to announce the fact that the United States is in a recession based on this data. It's the job of somebody else in another organization. Then once they come out with it, then everybody else can get on board with it. And I think that's something to me that was weird for him to ask that question, because he can't in his position come out and say, well, there's a recession if other people in other offices have not made that statement yet. But that's how organizations operate. Let's get back to it.
Thanks, Nick, Wall Street Journal. Chair Powell, I want to follow up on Gina's question. Down the pace of rate increase raises appears to have been socialized at your last meeting, largely before the past two CPI reports showed inflation decelerating in line with the committee's forecast this year. You just now talked about decisions meeting and being mindful.
And real quick, before we get into the next one, I forgot to talk about, he expressed again that the labor market is very tight on Main Street. We've seen a lot of information about the tech layoffs. That's cool. But on Main Street, small business owners do the majority of employment inside the United States. That labor market is extremely tight. And that's one of the issues, right? So their attitude is that we can continue to raise the unemployment rate, but it's not going to be at a rate to where it can be detrimental or disastrous to the United States economy, right? But it does mean somebody's not going to have a job. Let's get right back to it. My fault.
Of the lags of policy. Does that mean, if things equal, you would feel more comfortable probing where the terminal rate is by moving in 25 basis point increments, including beginning at your next meeting?
So I haven't made a judgment on what size rate hike to make at the last meeting. But what you said is broadly right, which is having moved so quickly and having now so much restraint, we think that the appropriate thing to do now is to move to a slower pace, and that will allow us to feel our way and get to that level, we think, and better balance the risks that we face. So that's the idea. It makes a lot of sense, it seems to me, particularly if you consider how far we've come. But again, I can't tell you today what the actual size that will be. It will depend on a variety of factors, including the incoming data in particular, the state of the economy, the state of financials.
With the CPI report, if it had come out last week, do you think it would have changed some of those forecasts in today's S&P?
No, absolutely not. No, as a just a matter of practice, the SEP reflects any data that comes out during the meeting, and participants know that they know this, that they can make changes to their SEP during the meeting, well in advance of the press conference, so that we're not running around. But that's not the case. It's never the case that the SEPs don't reflect an important piece of data that came in on the first day of the meeting.
Thanks, Rachel.
Hi, Chair Powell, Rachel Siegel from the Washington Post. Thank you for taking our questions. I'm wondering if we could talk about the projection for the unemployment rate. Why has the Fed raised its unemployment projection? Is it because the model suggests that a higher terminal rate would automatically cause a higher unemployment rate? Or are you seeing signs that the labor market isn't quite as strong as we think it is now? Thanks. No,
it's not about the strength of the labor market. The labor market is clearly very strong. It is more just that, by now, we've continually expected to make faster progress on inflation than we have ultimately. And that's why the peak rate for this year goes up between this meeting and the September meeting. You see the fact that we've made less progress than expected on inflation. So that's why that goes up. And that's why unemployment goes up, because we're having to tighten policy more. And so it didn't go up by much in the meeting, I don't think, but that's the idea, is slower progress on inflation, tighter policy, probably higher rates, probably held for longer, just to get to where the kind of restriction that you need to get inflation down to 2%.
Do you have a sense of, in order to get to that number, how much of that could be caused by layoffs versus vacancies trimming or changes to the labor force population rate?
It's very hard to say. You can look at history, right? And history would say that in a situation like this, the declines in unemployment would be more meaningful, I think, than what you see written down there. But why do we think that is the case? So I'll give you a few reasons. First, just is that there's this huge overhang of vacancies, meaning that vacancies can come down a fair amount. And we're hearing from many companies that they don't want to lay people off, so that they'll keep people because it's been so hard. I mean, I think it feels like we have a structural labor shortage out there, where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce. So the fact that there's a strong labor market, means that companies will hold on to workers, and it means that it may take longer, but it also means that the costs in unemployment may be less. Again, that we're going to find out empirically, but I think that's a reasonably possible outcome. And you do hear, many labor economists believe that it is. So we'll see, though.
Colby.
Thank you. Colby Smith with the Financial Times. How should we interpret the higher core inflation forecast for 2023 in the SEP? Does that not then suggest that the policy rate currently forecasted for next year should actually be higher than the 5.1 medium estimate penciled in?
Well, I think that's why one of the reasons it went up was that core came in stronger this year. Yeah, what you see is our best estimate as of today, for how high we need to raise rates, to how much we need to tighten policy to create enough restrictive policy to slow economic activity and soften the labor market and bring inflation down through those channels. That is the estimate, best estimate we make today. And as I mentioned, we'll make another estimate for the next SEP, and we'll, of course, between meetings we do the same thing, but we don't publish it.
Okay, let's stop there because we want to go to that. So the goal is to slow the economic activity and slow the labor market. And he just keeps reiterating that point over and over again. He keeps talking about how strong the actual labor market is, right? And another thing, we want to give another heads up, because we talked about this last time. Look at who's in the room. So first, look at the tone of the room. Everybody's calm, everybody's chill, everybody relaxed, people just asking their questions. Nobody's yelling and shouting. One guy asked a question out of turn. I don't know, where he came from, but it is what it is. But look at the media outlets in the room. And then ask yourself again, all of these people claiming that Black people, or quote unquote people of color, are their target market. We understand historically, when the labor market softens, Black men disproportionately are the highest amount of people unemployed inside the country. We know Black women are the lowest wage earners inside the United States. This man keeps talking about wages are too high, right? How come that's not important to the viewership or the readership or the circulation group of Black media outlets, right? So this is what you want to ask yourself. All of the media outlets that claim that they're doing Black media, are they not able to get a media pass to be inside this room? or do they believe that it's just not important to their audience? Because what they're talking about in this room, based on employment trends historically inside the United States and payroll trends or income trends inside the United States historically, you can just go pull the BLS data. What they're talking about, where they need to take the economy to lower inflation, will impact those two groups, right? And that's why you got to ask yourself, these quote unquote black corporations, media outlets that are covering everything else under the sun, how come either they can't get a media pass to get inside it, because sometimes you cannot get media passes to certain events, or they don't believe it's important to their audience, therefore they don't cover this, but this monetary policy will impact their audience. Because, give you an example, you can go to a lot of major cities and currently now in a low unemployment rate, right? They're at a low unemployment rate, but you go to a lot of the major urban areas and the black male unemployment between 18 and maybe 40 is going to be around 35 to 40%. Black women still being the lowest wage earners in those areas, even though they may be unemployed at a higher percentage than black males. If they continue to tighten the economy, take liquidity out of the economy, and increase unemployment, right? Who's going to be most impacted? The people that are already the most vulnerable. This is what I want you to, so this is why I tell everybody over and over again, the conversations that we think are important, right? They tell people what we're voting for, and they communicate to people what information they should keep getting us. And then we get mad about stuff, but we was never tapped into it from the gate. Let's get back to it.
Victoria.
Victoria Guido. I wanted to make sure I understand specifically what's going on in the SEP, because you all expect rates to go higher, but you're also more pessimistic about what inflation is going to look like next year. And I was just wondering, given that we have seen some cooling in inflation, is that primarily that you expect wage growth to be sort of a headwind?
And we're going into next year with higher inflation than we had thought, right? So we're actually moving down to the level that we're moving down to next year is still a very large drop in inflation from where inflation is running now, well more than a 1% change in inflation. But remember that the jump off point at the beginning of the year is higher. So we're moving down still by a very large chunk. I don't think the policy is having any less effect. It's just starting from a higher level at the end of 2022. So we're getting down. I believe the median is 3.5%. That's a pretty significant drop in inflation. And where's it coming from? It's coming from the goods sector clearly. By the middle of next year, we should begin to see lower inflation from the housing services sector. And then, the big question is how much will you see from the 55% of the index, which is the non-housing services sector. And, that's where you need to see, we believe you need to see a better balancing of supply and demand in the labor market, so that you have, it's not that we don't want wage increases. We want strong wage increases. We just want them to be at a level that's consistent with 2% inflation. Right now, if you factor in productivity estimates, standard productivity estimates, wages are running, well above what would be consistent with 2% inflation.
Okay, so he just told you again. If you factor in these particular elements, wages are running well above what we would consider to be at 2% inflation. Okay? He's continuing to communicate what the real issue is. Okay? And I think that's what a lot of people are missing out on. Once again, the information that you're tapped into is letting everybody know what's important to you, and they just continue to feed you more of that. So if I show up every day to eat a certain meal, I'm telling people that's what I want. And so the grocery store says, hey, order more of that food, because that's what keeps moving. That's what we can turn over. And what we can't turn over, don't order that anymore, right? So he's communicating to you what they think is really the choke point in the economy, right? Which is employment and wages. That's really what they need to get on top of, because they really believe the supply chain issues and the housing issue is going to work itself out. But they need to figure out how to continue to get on top of this wage and labor issue to get that employment back, to get the inflation back down to 2%, because they're saying based on where wages are at right now, they're too high to get to 2% inflation, which is you got to understand that a bunch of people are sitting in the room saying people are making too much money. Now, their money's not going to be impacted, but everybody else's money will be impacted. And people make decisions like this every day. Let's get back to it.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. Some of your colleagues have been pretty explicit that they can't imagine rate cuts happening in 2023. That's certainly not implied by the SEP. But futures markets have priced in some easing in the back half of next year. What's your view of the likelihood of any kind of rate cuts next year? What circumstances might make that plausible?
You know, our focus right now is really on moving our policy stance to one that is restrictive enough to assure a return of inflation to our 2% goal over time. It's not on rate cuts. And we think that we'll have to maintain a restrictive stance of policy for some time. Historical experience cautions strongly against prematurely loosening policy. I guess I would say it this way. I wouldn't see us considering rate cuts until the committee is confident that inflation is moving down to 2% in a sustained way. So that's the test I would articulate. And you're correct. There are not rate cuts in the SEP for 2023.
Steve Matthews with Bloomberg. Let me ask you about China. In the last few weeks, China has abandoned its COVID policy and been reopening pretty strongly. I'm wondering if you see that as disinflationary because you're seeing supply chains improve, or inflationary because it obviously brings a lot more demand globally, improves the global outlook for growth and for commodities prices.
And so you're right. Those two things will offset each other. Weaker output in China will push down on commodity prices, but it could interfere with supply chains ultimately, and that could push inflation up in the West. It's very hard to say, how those two will offset each other, and it doesn't seem likely actually that the overall net effect would be material on us. But to your point, China faces a very challenging situation in reopening, and we've seen waves of COVID all around the world can interfere with economic activity. China, a very critical manufacturing place for manufacturing and exporting. Their supply chain is very important. And China faces a reopening. They've backed away from their COVID restriction policies. There could be very significant increases in COVID, and we'll just have to see. It's a risky situation, but again, it doesn't seem like it's likely to have material overall effects on us.
Okay, so I want to stop there. So first, I'm gonna give a disclaimer. Jerome Powell, being the chairman of the Federal Reserve, has access to information I would never get access to. However, I think he kind of soft shoot his analysis of China. And I've been saying this for a very long time. China's getting ready to reopen their economy. We're projecting currently now that as a result, we're going to get around 1 million deaths in China. Now, if you look at China's overall population, that's going to be a very small amount of their overall population. And we understand the way the Communist Party of China deals with its citizens. It has no concern for the life of its citizens. It never has. It just sees people as essentially numbers on a page. And if it takes 1 million people to get the economy back in order, that's just going to be 1 million people, right? We know historically that's not going to be an issue for them to sacrifice 1 million people to get to where they want to go. They've shown that that's their attitude over human life, right? However, if they open up the economy and China's economy goes back to full bore, based on stock market sharks and how we analyze things with our desk, we believe that that's going to create more demand on energy. And then we believe that there's more demand on energy that eventually will come backside to the United States. And that will start to raise inflation, because one of the reasons why inflation has softened over the past few months is gas costs have gone down. China goes back full bore. It's going to create more of a demand on energy. And as a result, right, it could create inflation back over here because of that demand on energy, because speculators, what they're going to do is they're going to start moving up what they believe energy is going to be in the future. And the contracts are going to start increasing. And I don't really want to get into the oil market and how that works with futures contracts. Next scenario, if China has another COVID outbreak or pandemic outbreak, I apologize, and they shut everything back down. Well, what can we get again? Because they're our largest manufacturing partner, we could get supply chain inflation again. So we'll be right back to where we started with supply chain inflation, because they can't manufacture, which means we can't get the supplies from them, which means the dollars that are in the particular economy start chasing after those particular goods that are not there, which increases inflation. And then we still have the labor market situation. So to me, this China situation is very precarious. He soft shooted, which is his job. And then also he has access to information that I would never get access to, because he's the chairman of the Fed. And I think that because this is so accessible to the average American, they don't really realize who this guy is. And you just don't get this job by like putting in an application through monster.com. Like, you got to really know people to get in these positions. So because of that, you get access to information that the average person would never get access to. So he may know something about the situation that I don't know, which is why he's giving a very optimistic analysis of the situation. Or like I said, he may just be playing it down the middle because that's what he feels like his job is to do. Let's get right back to it.
Chris.
Hi, Chris Rugaber at Associated Press. Thank you for taking my question. I wondered if you could comment a bit more about yesterday's inflation report. It showed inflation cooling in all three of the categories that you laid out at Brookings. Are you confident that you're seeing real progress on getting in control? Are you still worried it could slip into some kind of unentrenched, upward spiral? Thank you.
Right. So the data that we've received so far for October and November, we don't have we have some remaining data to get in November, but they clearly do show a welcome reduction in the monthly pace of price increases. As I mentioned in my opening statement, it will take substantially more evidence to give confidence that inflation is on a sustained downward path. So the way we think about this is this. This report is very much in line with what we've been expecting and hoping for. And what it does is it provides greater confidence in our forecast of declining inflation. As I mentioned, we've been forecasting significant declines in overall inflation and core inflation in the coming year. And this is the kind of reading that it will take to support that. So really, this gives us greater confidence in our forecast rather than at this point changing our forecast. In terms of the pieces, we have been expecting goods inflation to come down as supply chain pressures eased. That's happening now. Housing services, as I mentioned, there is good news in the pipeline. As long as new housing leases show declining inflation, that will show up in the measure around the middle of next year. So that should help. And the big piece, again, is core services ex housing, which is very important. And we have a ways to go there. You do see some beginning signs there, but ultimately that's that more than half, as I mentioned, of PCE core index. And it's very fundamentally about the labor market and wages. If you look at wages, look at the average hourly earnings number we got with the last payrolls report, you don't really see much progress in terms of our average hourly earnings coming down. Now there may be composition effects and other effects in that, so we don't put too much weight on any one report. These things can be volatile month to month, but we'll be looking for wages moving down to more normal levels where workers are doing well and ultimately their gains are not being eaten up by inflation.
Michael.
Excuse me, Michael McKee from Bloomberg Radio and Television. There's a little bit of a disconnect between the optimistic view you just expressed about the economy and the changes that you've made in the SEP. And I'm wondering if you're reacting to the fact that the markets have loosened financial conditions, or if you feel the Fed may be a little bit behind on inflation, whether the recent disinflation we're seeing is transitory or not, and how this affects the idea of a soft landing if you're projecting just 0.5% growth for this year.
So if I think I got your question. So, one thing is to say is I think our policies getting into a pretty good place now. We're restrictive, and I think we're getting close to that level of sufficient. We think sufficiently restrictive. We laid out today what our best estimates are to get there, it boils down to how long do we think this process is going to take. And of course, we welcome these better inflation reports for the last 2 months. They're very welcome, but I think we're realistic about the broader project. So that's all. That's the point I would make. It's we see goods prices coming down. We understand what will happen with housing services, but the big story will really be the rest of it, and there's not much progress there, and that's going to take some time. I think my view and my colleagues' view is that this will take some time. We'll have to hold policy at a restrictive level for a sustained period, so that two good monthly reports are very welcome. Of course, they're very welcome, but I think we need to be honest with ourselves that there's inflation. 12-month core inflation is 6% CPI. That's 3 times our 2% target. Now, it's good to see progress, but let's just understand we have a long ways to go to get back to price stability.
Well, do you think the soft landing is no longer achievable?
No, I wouldn't say that. No, I don't say that. I mean, I would say this. To the extent we need to keep rates higher and keep them there for longer, and inflation, moves up higher and higher, I think that narrows the runway. But lower inflation readings, if they persist in time, could certainly make it more possible. So I don't think anyone knows whether we're going to have a recession or not, and if we do, whether it's going to be a deep one or not. It's not knowable, and certainly, lower inflation reports, were they to continue for a period of time, would increase the likelihood of a. So I would put it this way: of a return to price stability that involves significantly less of an increase in unemployment than would be expected given the historical record.
Brian.
Hi, Chairman Powell. Brian Chung, NBC News. You warned Americans of pain earlier this year as the Fed hikes rates, but with the Fed now expected to raise rates higher than you thought when you first said that, just wondering where we are in that pain. How would you describe that to Americans if the projections on unemployment find themselves? That would be 1.6 million Americans out of jobs.
So the largest amount of pain, the worst pain would come from a failure to raise rates high enough and from us allowing inflation to become entrenched in the economy so that the ultimate cost of getting it out of the economy would be very high in terms of unemployment, meaning very high unemployment for extended periods of time, the kind of thing that had to happen when inflation really got out of control and the Fed didn't respond aggressively enough or soon enough in a prior episode, 50 years ago. So that's really the worst pain would be if we failed to act. What we're doing now is, it's raising interest rates for people. And so people are paying higher rates on mortgages and that kind of thing. There will be some softening in labor market conditions. And I wish there were a completely painless way to restore price stability. There isn't. And this is the best we can do. I do think, though, that and markets are pretty confident, it seems to me, that we will get inflation under control. And I believe we will. We're certainly highly committed to do that.
Okay, and so he kind of reiterated again. So the question I want to ask the audience is that if you're in this position to where you have a certain amount of tools and you want to try to combat inflation, and based on your tools, by you combating inflation is going to raise the unemployment rate. The guy said estimated around 1 point something million, but in your attitude is the only way to actually deal with inflation and not cause more unemployment down the road is to allow for people to be unemployed currently or for the next 1 to 2 years and then have them just figure it out in this economy. Do you think that's an acceptable decision? And these are the kind of things that I think a lot of people don't really ask themselves. This type of stuff I used to teach people in my Dark Persuasion course, because most people are not forced to make these type of decisions. They're not used to making these type of decisions. They're used to just make extremely very personal decisions. And then when they get caught up in it, they blame somebody else. Right? When you're trying to manage an economy, you're never going to get everything that you want. So the idea of trade-offs, a lot of y'all first heard that from a guy named Kevin Samuels. That's not something he created. That's really how economic policy is based on. So he heard that from somebody else, and he kind of brought that to mainstream Black YouTube. But the concept of trade-offs in economic policy is what all economic policy is based on. And anytime you set an economic policy, everybody can't win. Somebody's going to have to get the short end of the deal, right? Because you believe that's going to help us get a larger benefit down the road. And somebody has to make those decisions and understand that those decisions have to be made. If not, you just get frozen and then inflation continues to go up, which will unemploy people down the road because a job, if they can't afford to hire you because they can't pay you, right, then they can't hire you. So you're going to be unemployed anyway. So you have to ask, how do we manage these situations, understanding that everybody's not going to get what they want in this situation. In fact, some people are going to get the short end of the stick. Let's get right back to it.
Brady.
Thank you, Mr. Chair. Grady Trimble with Fox Business. You've reiterated today, and the committee has reiterated its commitment to that 2% inflation target. At a point where you actually evaluate that target and maybe increase your inflation target if it is stickier than even you think it is.
Okay, and I want to stop this real quick because he's from Fox Business News, and I want you to, catch or notice the fact that, Fox is a very inflammatory network. If you notice, he didn't ask about Biden, right? He didn't ask about the computer or the Twitter stuff that we're supposed to be worried about from Biden's son. And he also didn't ask about CRT, right? And this is what I want to continue to reiterate to you. You have to understand how to conduct yourself in certain rooms or certain environments. He knows that in this room, all of that ad hoc political stuff that we do on the other network for Fox, it don't work in here, right? We're here to talk about and this is what I try to get people to continue to understand. When we say this is the topic and a person comes in with everything else except that topic, what are they communicating to you? I don't know how to communicate in this type of environment. So even though he's from a very provocative, polarizing, ad hoc media platform, he understands how to make sure that his questions are on topic. He's not asking about Biden. He's not asking about the computer. He's not asking about, when are y'all going to release the Twitter data? He's not talking about, is it CRT? He's making sure he stays to the topic That is what we're talking about inside this particular room. Let's get back to it.
That's just so changing our inflation goal is just something we're not thinking about. It's not something we're not going to think about. We have a 2% inflation goal, and we'll use our tools to get inflation back to 2%. I think this isn't the time to be thinking about that. I mean, there may be a longer run project at some point, but that is not where we are at all. The committee, we're not considering that. We're not going to consider that under any circumstances. We're gonna keep our inflation target at 2%. We're gonna use our tools to get inflation back to 2%.
Nicole.
Thank you, Chairman Powell. Nicole Goodkind, CNN Business. As you monitor wage growth and unemployment data, I wonder if you're paying close attention to a sector or even income level. How do you have potential observations of inequality into your response, especially given the K-shaped recovery of 2020?
So I would go back to the labor market that we had in 2018, 19, 20. So what that looked like was wage increases for the people at the lowest end of the income spectrum were the largest. The gaps between racial groups and gender groups were at their smallest in recorded history. All of that because of a tight labor market, which had inflation running, just a tick below 2%, and the economy growing right at its potential. So that seems like something that would be really good for the economy and for the country if we could get back to that. And so that's what all of us want to do. We want to get back to a long expansion where the labor market can remain strong over an extended period of time. That's a really good thing for workers in the economy, and we'd love to get back to that. That's what our goal is. There's in the near term, we have to use our tools to restore price stability, but we can't. What we have to think about is the medium and longer term. If you think about it, the country went through a difficult time. I think much more difficult than we can think it would happen here, but it really set up our economy for several decades of prosperity. So price stability is something that really pays dividends for the benefit of the economy and the people in it over a very, very long period of time. And so when it is lost for whatever reason, it has to be restored and as quickly as possible, which is what we're doing.
In the short term, are you factoring in these exacerbate or potential exacerbations in the economy? Are you monitoring?
We do. Yes, we absolutely do. We look at, it's our regular practice to talk about unemployment rates by different groups, including racial groups and that sort of thing. We do. We keep our eye on that.
Nancy.
Okay, so he kind of spoke to what we were talking about. Unemployment based on certain racial groups. He says we keep our eye on that. They're going to they can't solve the problem where they're at, that Black men are disproportionately unemployed at a higher rate, especially in large urban areas, because it's something that's been going on almost 100 years, right? They also can't solve from their office that Black women are the lowest wage earners of any group of workers if you take them out as a segment, right? But they understand based on their policy how it's going to impact those people, right? So he can say, yeah, we take it into account, but there's really not a lot they can do about it based on where they're sitting. So if they're going to pursue price stability and lower unemployment, right, by lowering inflation, so they're going to pursue low inflation and full unemployment, they have already accepted that this amount of people are going to get sacrificed for us to get to that number. And many of them will be used to it. Why? Because all they've ever known is being at the bottom of the economy. It's only going to be unusual to you if it's not normal to you, right? So we have areas, I'm in Metro Atlanta. I can take you to areas of Metro Atlanta. They don't know what it's like to live in good times. Therefore, nothing is going to change for them because all they've ever known is lack, right? It's going to be the people that are going to get pushed down into that are going to have to make the adjustment. But the people that's all they've ever known, it's going to just be normal to them. And so this is how you get a continuity of economic equality, because that group never gets out to even understand what it feels like to not have to deal with that on a day in and day out basis. Let's get right back to it.
Hi, I'm Marcia Genzer with Marketplace. What do if the economy slows so much that we enter a recession before we see strong, consistent signs that inflation is slowing? In other words, stagflation.
So I don't want to get into too many hypotheticals, but it's hard to deal with hypotheticals. So let me just say that we use our tools to support maximum employment and price stability. I've made it clear that right now the labor market is very, very strong. You're at near a 50-year low. You're at or above maximum employment. In 50-year low in unemployment. Vacancies are very high, nominal wages are very high. So the labor market is very, very strong. Where we're missing is on the inflation side, and we're missing by a lot on the inflation side. So that means we need to really focus on getting inflation under control, and that's what we'll do. I think as the economy heals, the two goals come more into play. But right now, clearly the focus has to be on getting inflation down.
Greg.
Thank you, Chairman Powell. Greg Robb from MarketWatch. You spoke a little bit ago. You said that the U.S. it looks like we have a structural labor shortage in the economy. Could you expand on that? Talk a little bit more about that. And really, are you talking about action on increasing like legal immigration, things like that? Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think.
Okay, I'm gonna run that back to you because I think a lot of people are gonna miss what he just said. And what I want to really encourage you to do is for 20 seconds, eliminate what you think it is and listen to what he's saying. Just do it for 20 seconds, because a lot of times we come into a scenario with our mind made up on what our analysis is going to be, and we don't necessarily listen to what the information is telling us. So for 20 seconds, I want you to eliminate what you think it is, whatever narrative you brought into this video, and listen to what he told you, because I think a lot of people are going to miss what he just said. Let me go ahead and replay this real quick.
Things like that. Thank you.
So what I meant by that, the structural labor shortage, is if you look at where we are now, as I mentioned, if you just look at demand for labor, you can look at vacancies plus people who are actually working, and then you can take supply of labor by are you in the labor market, are you looking for a job or have a job, and you're more than 4 million people short. We don't see, despite very high wages and an incredibly tight labor market, we don't see participation moving up, which is contrary to what we thought. So the upshot of all that is the labor market is actually, it's 3.5 million people at least smaller than it should have been based on pre-pandemic, just assume population and reasonable growth and aging of the population. Our labor force should be 3.5 million more than it is. And that there are lots of easy ways to get to bigger numbers than that if you go back a few more years. So why is that? Part of it is just accelerated retirements. People dropped out and aren't coming back at a higher rate than expected. Part of it is that we lost 500,000 people who would have been close to 500,000 who would have been working, who died from COVID. And part of it is that migration has been lower. We don't prescribe, it's not our job to prescribe things, but I think if you ask businesses, pretty much everybody you talk to says there aren't enough people. We need more people. So I tried to identify that in a speech I gave a month ago, but I stopped short of telling Congress what to do, because they gave us a job, and we need to do that job.
Okay, so when he said migration has been lower, and I think a lot of people are not going to really understand what that means. I think I got a Laws of Game video on migration and people coming from south of the border, right? What we have to kind of understand in America is that capitalism is about creating surplus labor, okay? And there is always been a demand for more and more labor into America, because why? It creates more surplus, which means what? The average worker now has to lower, right, their expectations of working conditions, but also lower their pay. One of the things that they're saying is that there's less migration. Why do they need more migration into the United States? Because we need more people willing to work for less and to work under worse conditions than what we currently have, right? That's just my analysis. But he said on live tape, right, and I footnoted it, that we have migration has been lower. Well, why do we need more migration? Because we need more workers to create more surplus labor. Because I think they believe that if we can get more migration, the people that don't want to go to work will just get replaced by the people that do want to come to work because they'll come to America, and because they're so desperate for money, they'll take whatever job they can get. And I think a lot of, my audience, because most of my audience is a little higher educated, or they're more skilled and they're also more experienced. They don't have the understanding of maybe of somebody coming to this country and they working maybe at Tyson Foods in a packing plant, or they go into Tennessee, or maybe they go into Gainesville, Georgia, and they work in a chicken processing plant, or they go down to Florida, right, and they pick oranges, or they do sugar cane, right, or they go to Texas and they do watermelon, right, or they go to Alabama and they do watermelon, right? Or when I was in Orlando for the holidays, everybody that works in the hotels that does custodial work and also does the cleaning, the housekeepers, they're all immigrants, right? Either they're going to be Haitian immigrants, or they're mostly Latino immigrants now, because everything's starting to change in Orlando. A lot of the people that are we don't really understand that dynamic, because that's not really the jobs that we do. And that's something that they were talking about. The service sector, where I'm from, everything's a service job, right? This is what they're short at, because everybody left those jobs because of the pandemic, and then nobody's coming back in, right? And I think a lot of people are going to miss the fact that he's saying migration. And a lot of times in politics, they use this migration as this political football without understanding is that the billionaire capitalists want more migration, right? They don't want to have to negotiate with labor unions and negotiate with individuals that want a lot of money to work. They want migrants to come into the country. So this is really not a political issue. It's an economic issue, but it gets politicized because it gets people to talk and they can put their own 9 to 5. Let me explain something to you before we go to the next point. The United States can build a sub, an individual sub. That sub by itself is a top 10 nuclear power, not the whole sub fleet, just the one sub. So the United States can build one sub, and that nuclear equipped sub by itself is a top 10 nuclear power, just that one sub. To me, it's ridiculous to believe that we can't control our border, but it doesn't make economic sense to not allow people to come into the country, because why? We got to consistently create more surplus labor, right? And he's kind of explaining that we have a migration issue, right? Where we don't have enough workers for these jobs, which is increasing wages, and it makes sure that we have a shortage of workers, and business owners are complaining about that. Let's get back to it, because I don't want to be on this video too long.
Thanks. Jennifer?
Hey, Chair Powell. Jennifer Schonberger with Yahoo Finance. You say you expect growth of just 0.5% next year. Given that you've said the process of raising rates and getting inflation back under control will be painful, have you had discussions within the committee and addressed how long and or how deep of a recession you would be willing to accept?
No, I mean, what we do is we make our forecasts and we publish them quarterly. And if you look at those forecasts, those are forecasts for slow growth, for a softening labor market, by which I mean unemployment goes up, but not a great deal. And you see inflation, you see rates going up a lot, you see inflation coming down. Those are those forecasts, and that's really what they show. We're not, we all, of course, we don't talk about this kind of a recession and that kind of a recession. We make those forecasts. The staff runs, and you will see this if you look at the old Teal books, runs alternative simulations of all different kinds at every meeting, and we look at those too. And those will explore different things. But that's just upside and downside scenarios. Of course, that's responsible practice that we've carried on for many decades. But no, we don't. We haven't asked ourselves that question.
We'll go to Jean for the last question.
Hi, Jean Young with Market News. I wanted to ask about the SEP again. If you are reaching peak rates around 5% in the first half of next year and inflation starts to decline materially, that would seem to make the real rate gradually more restrictive. Is that something that's built into the projections and into models? Is that something you would want to see?
So we do know that, of course, that's something that we know and we see. But as I mentioned, we wouldn't, I wouldn't see the committee cutting rates until we're confident that inflation is moving down in a sustained way. That would be my test. I don't see us as having a really clear and precise understanding of what the neutral rate is and what real rates are. So that would mechanically happen like that. It'll be a test of for cutting rates. I think in the event, it'll be a question of, do we actually feel confident that inflation is coming down in a sustained way? Thank you very much.
Okay, and the end it is that Powell understands that if they cut rates right? It pausing is one thing, but if they cut rates and then because of really, to me, a geopolitical situation, right? China, Ukraine, Russia, energy, and inflation starts to spike back up, the market is going to go bananas, right? Because then now what are they? They're going to go past 5% now. And I think that's one of the reasons why they want to get it to a certain level and hold it and then continue to just observe data. Because they understand how bad it's going to make them look if they decide to cut the rate. Inflation, let's say 6 months later, starts to spike back up. Everybody's going to go crazy because why? They cut and then now nobody knows what they're going to do. It's going to create a large amount of anxiety and uncertainty in the market. And so I think that's one of the reasons why they want to get to a certain rate and hold there and then just continue to collect more and more data. And then based on their modeling, they can try to figure out which direction they want to go into. But that's all that's pretty much going to be the discussion. I appreciate everybody for coming through, but I want to really encourage people, like, if this is the type of stuff that you're interested in, I would encourage you to tap into it more and not be so dependent upon, I'm waiting for somebody else to tell me what this means, right? You don't have to be a genius. You don't have to go take a test. You don't have to go to college for 12 years to understand what this is, right? This information is publicly available to you. Everything they talked about, you can go look it up. You can go look up the Fed funds rate. Anything they talked about here, you can go look up, right? If you're reading it, on a high school level, you can understand what they're talking about. It's just about you wanting to have a better understanding and not feeling like I'm coming in the room with my own set of ideas around a situation. And then I'm going to make that be the narrative, regardless of the information that's being presented in front of me. That's what gets a lot of people caught up. And then people play to that. So where you never understand what's going on, like people that think it's political parties that are the reason why we have immigration, without understanding is that billionaire capitalists want immigration. They've always wanted immigration, not just from outside of the country into the country, but from one part of the country to another part of the country, right? So this is what people don't understand because, like I said, they go into the room with their mind already made up based on what the situation is going to be. We're going to read these comments and we're going to get up on out here. Appreciate everybody that gave me the super chats. Let me start at the top. Let me go here. Doom, doom, doom. Let me go here again. Let me start at the top. And let me get rid of this real quick. Okay, we good to go. Let me go ahead and read these comments and we're going to get up on out of here. So TW1, I appreciate the $3 super chat. Real Deal Financial, I appreciate the $10 super chat. Terrence, I appreciate the $4.99 super chat. GC, what's going on? Let me see. Drop 16 says they're going to try to bring in immigrants to bridge the gap. Most definitely. They've been doing that forever, though. And if it's not immigrants, then it's slave labor, but they're going to bring somebody in. Real Deal Financial says 3.3 million black jobs will go if the economy loses 10 million people. I believe you. So Emma Khan says no coverage. Where's Revolt TV or black media on this? They don't believe their audience is interested. And they might be right. Their audience may not be interested. Right? So, they probably have data to show that their audience only responds to certain stories. So then based on that data, that's what they go with. Right? But people complain about the stuff, but they can't even have a conversation about the information. But part of being an American is believing that somebody else is going to do stuff for you, in my opinion. And I think that breeds a lot of entitlement around certain things. And nobody's going to figure this issue out for somebody else. It just doesn't work that way. Because as long as a person doesn't understand the issue, even if they think they understand it, it benefits the people that actually do understand it, in my opinion. And then they go act on it. They just don't sit around and talk about it. So Engineering Cannabis says the monetary tightened by the feds affects blacks men the most. There's a direct correlation. The rates get higher, the more black unemployment rate increases. Yeah, if the raise in the rate correlates to higher unemployment, it will be detrimental to black men. But also be detrimental to black women too, right? Because he's saying that wages are too high. So wages are already too high, and we have a group of people where they're some of the lowest wage earners, but they're not lower than the immigrants that are going to come over and work for even less than them. So we have another group of people that we can get to work for even less than what we're currently paying the lowest wage earners, right? And this is why data is so important, because a lot of people are operating under a false pretense and thinking that's going to get them somewhere, and none of the data supports it. And there's always going to be exceptions to the rule, but we're talking about pretty much from a median standpoint. Ebony J says, appreciate the $4.99 super chat. They want to lower wages, but will inflation go down, or is that what they say to get what they want? I'm missing the point. We got to see. So they want to lower inflation, and they need wages to come down for that to happen, which really means they need more people to be unemployed. They believe higher wages are going to increase inflation, because normally when you have higher wages, the job has to pay you more, which means now they have to turn around and take those costs to the consumer, right? So that if they now have to transfer those costs to the consumer, that raises inflation, because now the consumer has to pay more for goods and services in the economy. So if we're trying to go to a hotel and the hotel in Orlando says we can't find anybody to work here, so to attract workers, we got to pay people $3 more than what we would normally pay them. Then they turn that cost back over to me. So now it costs more for me to stay at that hotel. And then my expectation of inflation starts to go up. I start to expect to pay a higher amount, right? So in my opinion, what they're saying is that the higher wages will increase inflation over time, because those jobs will pass that higher cost, right? Which they're going to be their expenses. They normally going to pass those costs through to the consumer and make the consumer pay for it. So Drop 16 says, you work with people from China and half the staff there has COVID. They'll believe you 100% next week. Yeah, it's going to be interesting to see how that rolls out. So Urban Homesteader says he keeps reiterating that unemployment is not at the level that contributes to 2% inflation. What if the level of employment does not ease because job openings consistently outstrip job seekers? We got to see how it goes, right? But in their mind, based on their models, if they keep raising the rate, it'll continue to contract growth, right? To, I think, where they'll start looking for workers, and they may even start unemploying people, right? So they just want to continue to destroy demand and stop any kind of growth. And they talked about that, to where business growth is starting to get flat. And I listened to CarMax call this morning. CarMax said that they was freezing corporate hires. They were firing their clerical people. The only people they were keeping on were their tech people, because they felt like when this thing turns around, they want to move very fast, and they don't want to have to go back into the economy and find their service techs. So they're going to keep their service techs, even though there's a slowdown. They're going to stop corporate hirings, and they're also going to fire their clerical people. So once again, being skilled, actually having real skills in this economy, is where it's at, but still, you can still lose your job. If somebody's going to fire you, they're going to fire you. So Life Beyond the Ring says he's concerned with the number threshold, but not the severe impact on people, on the average American making $38 a year, in particular people in color. So Life Beyond the Ring, I understand what you're saying, but my question is, if you had these tools, what move would you make? So let's get out of criticizing him and say, well, we was in this position, what would we do? If our goal was to lower inflation and to provide full employment, and all we had was tools to deal with demand, all we have is demand destruction tools. We don't really have any other tools. We can't impact supply chains. We can't impact what Putin decides to do. We can't impact what Chairman Xi decides to do. We can't impact what OPEC decides to do. So if all we have are demand destruction tools, and we have to fix a problem, then we have to fix a problem with demand destruction tools. So then the question I would ask you, and this is what I say that we're not having these kind of conversations, is that what would we do in this situation if it was us? This is what I used to teach people in my dark persuasion class, because most people, they've never been asked that question because they've never been in that situation, right? So that's the kind of thing, as opposed to just saying he's doing the wrong thing, what would we do if we was in his situation? Because then if it doesn't work, then it's all still going to be a negative impact. So regardless of what move we make, if it doesn't lower inflation, there's going to be a negative impact to employees or the labor. There's going to be a negative impact either way, right? So then what decision would we make? And that's what but see, that means I'm putting the responsibility back on my audience, which is not how you build a big audience, The way you build a big audience is you give them somebody to direct their anger at, not to tell them, okay, now it's your responsibility. I'm not talking about you personally, but I'm saying the way you build a big audience is you never put the responsibility on them. You say, here's the person we can look at that's the cause of our angst, right? And then they never have to be responsible for it. But somebody has to make the decision. It can't go unmade. So Urban Homestead, it says maybe the number of job seekers and jobs available can be no longer brought in line to the point where they support 2% inflation. We're going to see. I think currently right now, I don't see how they get to 2% inflation. Because from my understanding, I think the rate has to be higher than the CPI. So that means the rate has to be over 7%, but they believe the CPI is going to keep going down over the next 2 to 3 years, and that may happen. But I don't see currently where they're at, how they get to 2% inflation. I don't see how it's possible. But we got, another year to 2 to 3 years to try to figure this out, right? And it may take that long. So we may just be in for a rough 2 to 3 years for a lot of people. So, Newberman, I appreciate the $20 super chat. Metal Alchemy Brands, I appreciate the $5 super sticker. So Theo says his assessment of the labor market heavily biased towards demand side rather than supply workers. Well, Theo, all he has is demand destruction tools. He don't have supply side tools, right? He just has demand destruction tools. So if I tell somebody, hey, I need you to fix this car, well, whatever tools they show up with is what they got to use to fix the car, right? I've seen people, I don't know, some lots have the big hydraulic lifts. I've seen other people with just the 2-ton lifts. They both jack the car up, but to me, one's safer than the other one. I've seen also where you drive the car into a bay and then you can walk under the car and fix the car. But they're all tools to get the job done. It's just based on what tools you have available. That's what you have to use. All he has is demand destruction tools. I don't see what other tools he has to use. GC said just a byproduct of capitalism, most definitely. That's just the game we playing. So Urban Homestead, it says accelerated retirements, C-19, and immigration being stopped. That's why the labor shortage is intractable, and therefore wage inflation cannot be suppressed at more historic levels. Urban Homestead, I think they opened up the borders again, because that's what they've been doing the whole time. I think they got to open those borders back up and get some more people over here. And I think that's pretty much what he communicated. That's what they have to do. Now, they're going to turn it into a political issue, but it really is an economic issue. This country doesn't exist without cheap labor. Like, it just doesn't. I don't think people, this is not like this techtropolis that people think we have in America. It just doesn't exist. Even with all this automation, a lot of the agriculture can't be automated. I come from an agriculture state. It can't be done with robots. They'll damage the actual product. Now, maybe in 50 years it can be done, but currently right now it can't. Right? They can't pick all those strawberries in Plant City, Florida with robots. Right? They'll damage the fruit. So there's still a need for literally thousands of low paid agricultural workers, not only in Florida, but also in California, Texas, Alabama. A lot of manufacturing still needs them. They're still needed, even with all this automation. That's really a conversation for a higher skilled person. There's still a lot of lower in jobs. I'm from a hotel city. They still need labor to clean all those rooms every day. They don't have a iRobot that can clean the rooms yet. Eventually they will, but right now that's still a labor position. It's a big HR push to do all that, and it's every day those rooms got to get cleaned. All that linen got to get washed. That's being done with people. It's with bodies. It's just a bunch of bodies doing that. And those jobs don't pay a lot of money, but they're very easy to get. So I don't see that automated anytime soon. Let me see. So Emika says if we had a ruling class mentality, we would hike the right 5% out of the gate and get it underway instead of dealing with the ramifications and keep it pushing. Yeah, I thought they would hike a lot faster and harder earlier. For some reason, they've chosen not to. I guess they had data to show that that wouldn't be the best way to go about it, because to me, this is being dragged out, right? You could not have told me at this time last year that this bear market would last a year. It's still going on. So we're over a year because it started in November. I would have been like, man, you tripping. All right. Because I was telling people this thing will be over by the summer. I was wrong. Right. Now I made a lot of money this year, but I was wrong. Still making money. But you could have never got me to believe they would stretch this thing out this long. But I've never traded a quantitative tightening market. Right. Never traded one. The pandemic was not a quantitative tightening market. It was an event. I traded the pandemic. That lasts like 3 weeks to a month. You could have not got me to believe that they would stretch this thing out a year. I just didn't believe it. I was like, there's no way in the world they're going to do that. But they did it. And they're still doing it. And they still have yet to unwind the balance sheet. And there's also going to be an economic response to them unwinding the balance sheet, selling all that MBS. They got to get all that off the books. And that's also going to, so what's the market going to be for those securities if nobody doesn't want to buy them? Because the Fed was buying it all up. Now the Fed's going to come out of the market and say, okay, well, you buy it. Well, nobody wants to buy it. It's going to just sit there. So what's going to happen? Yield's going to start spiking. Are they going to have to come in and save that market the way UK had to come in and save their gilt market? So these are kind of questions people got to ask themselves. Then if they were the Fed, and let's say the MBS market, the yield spike, if they were the Fed, would they come in and save the market, or would they not save it and just let the yields keep going up? Because it's easy to say they shouldn't do it, but what will we do? And would we just let the MBS market just, have yields at 50%? What will we do? So I think we need to start asking ourselves these kind of questions so we can start positioning ourselves to be in these situations and manage these situations in the future, because nothing lasts forever. And we have this impression that the people that are in power today are going to always be in power. That's false, because they have not always been in power. Ebony, I appreciate the $4.99 super chat. Thank you. Appreciate it. Have a good holiday. So Amika says, Jeremy Hunt signaled to the people in UK the recession there may last 10 years before a turnaround. Yeah, I've told people I think the collapse in the world financial markets is going to come out of the UK. I don't think it's going to come out of Japan, unfortunately for them. I think it's going to come out of the UK. I think their economy is hanging on by a string. And I think something's going to happen there, and it's going to start there and it's going to spread across the whole world, right? If we don't go back into a quantitative easing cycle. So Metal Alchemy says you saw a machine at McDonald's that rotates and fills 6 drink cups autonomous with drink orders. I feel you. See, I don't eat at McDonald's, so I would never see that. Yeah, there's going to be a lot of automation. But like I'm from a service city, there's a lot of things that still can't be automated, and they're still going to need labor. And so for a lot of people, the automation is more of a higher skilled, higher educated conversation. There's still a lot of jobs in the city that I'm from, and there's more hotels. The only place in the country that has more hotels than the city that I'm from is Vegas. And every one of those hotels needs labor to clean the whole hotel every day. They can't clean it once a week. The whole hotel has to be cleaned every day, right? And so those take bodies, right? And so those bodies also have to be managed. So one of the things you got to do, and that's same thing with other restaurants. So yeah, that's fast food, but what about sit down? Sit down, somebody has to cook. Somebody has to do tables. You need bus boys, all that. So I'm from a big service city. It just needs bodies, and it's going to continue to need bodies for a very, very long time. He sensed that it'd be crazy if we got another full bear market for 2023. Yeah, we got to see it. Is a dark persuasion course available? It's not a course, right? And it's not for the mainstream. Cheap labor is needed, but we have a whole labor class that's ignored. It's shady to pay a legal immigrant a low wage while the non-ex felons the same opportunity at that same wage. So VMJM, if you feel that way, I would encourage you to offer ex-felons a higher wage or help create policy to where illegal immigrants don't get the low wage. That's what I would encourage you to go do. CDL drivers will be in demand. I feel you. Yeah, they still got to move freight. All these small businesses can't afford sophisticated automation. I feel you. A lot of it is unnecessary. A lot of automation businesses use it. It doesn't make anything easier. I was dealing with a dental office. Their automation gave me a headache. A lot of people buy these programs that I don't think they actually workflow tested, and it just creates a headache because it doesn't make things easier. It just makes things more difficult. You know, there's a lot of programs that are out that don't think about the end user. They just get rid of employees, you know, but it is what it is. Appreciate everybody for coming through. Want to encourage everybody to make sure that they stay safe this holiday weekend. Make sure they stay safe the last week of the year. It would be unfortunate if, you know, everybody couldn't make it through the year. Want to appreciate everybody for coming through. I know this has been a little bit of a longer live stream and more about meat and potatoes and everything else. But this is the kind of conversations I have on a regular basis because of what I'm involved in. So it's very normal to me. And I want to really encourage people to try to figure out, you know, how they can be the change they want to be and how they can start finding more value in talking about stuff that's really just trending topics. But a week from now, it's not going to mean anything. This stuff here is going to still be impacting people 6 months, a year, 2 years, 3 years out, because they forecasted out 5 years, right? And like I said before, it's very interesting that none of the quote unquote black media publications cover this, right? In depth, but they talk about everything else. Deion Sanders going to be good. You know, he got damn near $10 million a year deal on the table. He going to be all right. A lot of people that don't have that kind of deal on the table, and no disrespect to him, he's worked for that. They're not going to be all right. And that's the majority of people that are subscribers to these media platforms. But once again, those media platforms probably have data to show that this type of content is not important to their audience, right? Appreciate everybody for coming through. David W. Williams, also known as Diamond Dave. Make sure you hit us up for the sale before the year's over. That sale will be over. So get in where you fit in. Talk to you later.